and welcome to this video on equity crowdfunding and valuations. So we get this question a lot in equity crowdfunding. Well, what do I get out of it? What's the return on investment? Well, in equity crowdfunding, there is no return on investment. You're buying stock in a company which is private. That means the shares are illiquid. There's no guarantee that you'll ever be able to sell them. Now, obviously, companies want to give their shareholders liquidity, which means the ability to sell. So down the road, there's probably going to be a liquidity event for shareholders, which could be an IPO, it could be a direct listing, it could be a tender offer, it could be a number of things. It's not necessarily an IPO, it could be lots of things. In a liquidity event, shareholders will be able to sell them on an exchange such as the NASDAQ, the New York Stock Exchange, when shares would be publicly traded. At that point, after the lockup, you can sell them at whatever the market rate is. Now, as far as the return on investment, you're basically betting on the underlying company's growth. So if that company grows, so will your stock price, so will your equity. Equity is basically the value in the stock price. So every private equity offer, whether it's crowdfunding or a Reg D private placement or something else, needs to have a stock price and a valuation. So for example, let's say that the company you're investing in has a $100 million valuation. In public stocks, they call that the market cap. The market cap is the total value of the entire company. If you add up all the shares plus the shares outstanding times the stock price, basically equals the valuation or the market cap. So let's say, for the sake of argument, the company you're investing in has a $100 million valuation. Years go by, they grow and grow. Now they have a $300 million valuation. That means you've achieved a 3 times return on your investment. So private equity or venture capital is very risky and you can lose all the money and it's not liquid. So we have to assume that if you're investing in a private company, whether it's a very early stage company or whatever is the stage, you have to consider it high risk. However, you get paid to take that risk. So not every deal is going to be a Google or an Amazon or a Facebook, which generates a high return, but it is possible. So any private deal, you could have a very high rate of return if, let's say, the valuation when you invest is 100 million, and then at the liquidity event, the valuation is $1 billion. That will be a 10 times return on your money. Now, the valuation is important because that's actually what the company is worth. Where you're going to see that is in the stock price. Now, there can be some things like stock splits or reverse split, or they can change the number of shares outstanding. They can increase them, they can decrease them, they can do a number of things. But basically, as the equity goes up, or the market cap, or the total valuation of the whole company, the stock price is also going to go up. So if the 100 million valuation company, for example, was $10 a share, and then now it's $1 billion valuation, the share price should be $100 or 10 times that. So that's basically the essence of investing in crowdfunding. Equity crowdfunding. You're betting on the company and you're getting shares in the company. And the idea is that crowdfunding is raising a small amount of money from a large amount of people. Many companies like to do crowdfunding because it gives their users or their actual consumers the chance to invest in their company, because typically in private markets, it's only for accredited investors or big institutions that have lots of capital. And you usually have to be accredited. For equity crowdfunding, you do not need to be accredited. We look forward to seeing you in future videos and hope you have a great day.